Carmine Sibio, the global chairman and CEO of EY, is here in India just ahead of the announcement of his successor, which is expected in November. Sibio has been the CEO since 2019 and is serving out a 2-year extension, one that he got to oversee the rollout of his audacious, ambitious plan of splitting the firm's consulting and audit businesses. Called Project Everest, this turned out to be a peak that Sibio couldn't climb and was eventually forced to call off the plan earlier this year. Hello and welcome to the Global Dialogue. I'm Shereen Bhan, and joining me on the program once again is the Global Chairman and CEO of EY, Carmine Sibio. Thanks very much, Carmine, for joining us here in India. Welcome back to India. This is your first visit since the pandemic.
It is, Shereen, it is. It's great to be here. It's great to see the warm weather. It's
fantastic. Warm weather. We're going to get you to exercise a little bit in India.
I love it. I could use the steps, so this is great.
Hopefully we'll get to the 10,000 mark. But let me start by asking you about India and your thoughts about the growth that we're seeing here, as well as the opportunities that you believe foreign investors will be looking at.
So I've said this before to you, but now I believe it even more than the past couple years. I think India is probably top of the list for global investors in terms of where to invest, in the next few years, or even more than that. And a lot of it has to do with obviously everything India has going for it. Obviously, the most obvious thing is demographics, but it's not only that. It's entrepreneurship. It's frankly, the ability for business to flourish. And, I've said in the past that sometimes, bureaucracy got in the way, but that seems to be going much better. And there's a huge appetite to invest in India from around the world today, including from an EY perspective.
I'll get to the EY bit in just a second, but you talk about this appetite for investors who are looking at India. And we've seen private equity and we've seen a lot of sort of control deals happen here in this space as well. You talked about what's propelling the growth story in India, but what is it that investors are looking for? Are there any sectors in specific that you find more interest in?
Certainly consumer and anything to do with consumer. I met with a few clients today that are franchisees of other brands but have brought it to India. And so consumer for sure, technology obviously. There's great entrepreneurship in India around tech, and I think there will be more and more around AI as well. So that's something that I think India's poised to do more in, and I could tell you a little bit about what we're doing, but it's so consumer tech. I think now. The sector that I think India has a great opportunity in is manufacturing. That's something that obviously India can capitalize in terms of what's happening, in terms of people moving their supply chains away from China. And I think India is a good place for that to happen. And that's something that I think, skilling, and India skilling its people. So, to be more apt in terms of manufacturing will be important. So I think, I would say those are maybe top three. I mean, private equity is always part of it if you count that as well. So those are three.
You talked about the manufacturing opportunity as well as this reorientation or reglobalization that we're seeing in light of the geopolitical flashpoints. And we now have more to deal with given what's happening with Israel and Palestine. But specifically on China, what's the view? The recovery is slower than expected and anticipated. We don't know how the real estate sector is going to unravel and what that will eventually lead to, whether it will lead to systemic risks in China. But what's the outlook now on China? I think the jury is clear that decoupling is not something that we're going to see happen. We probably will see de-risking, but not decoupling, which was the expectation.
I think that's true. Look, I think all companies today are looking at their China operations, and number one, making sure that data that's produced in China stays in China. That's important. It's important to the Chinese regulators. So we have all our clients looking at, what technology they're using in China, what data they're producing in China, and this is important to both sides. And so that's number one. Number two, all our clients are going down the route of more of What's produced in China is sold in China. What's produced elsewhere is sold elsewhere. So those, I would say, are two rules of thumb. And then, I do think the world wants to see where China is going from a future perspective. I think their economy has slowed, and they're still kind of coming out of the COVID period. And then there's going to be, right now, I would say, there's acceptance to invest in China in certain sectors, certainly not in tech, and certainly not in any kind of sector that could have a geopolitical consequence. But in sectors like consumer, many companies, both American companies and European companies, do want to take advantage of the Chinese consumer. And so when you talk about things like retail and fashion and so forth, that's still a huge investment for companies in China.
Global growth, and the World Bank and the IMF pegging global growth at about a little over 3%. What's the expectation specifically as far as the US is concerned? Because the resilience has surprised many on the upside.
Yeah, it has surprised on the upside from a US perspective, but I think that's slowing. You're starting to see more cracks in terms of the consumer. There have been two things that have been propelling growth in the U.S. and it's been actually propelling the U.S. economy. One is purely the consumer. And the consumer's been incredibly strong. They've been buying. But now you're starting to see the consumer slow. More in the middle income area and the lower income area. The high income area is still pretty strong. But you're starting to see some slowing. And then also the other piece is jobs. And jobs, there's still a lot of jobs and job needs in the U.S. But the jobs are two-front. One, they're in the service sector where there's just not enough people. So people working in restaurants and hotels and so forth, there's just not enough people. So very simply, people are saying, some of the influx of even illegal immigrants that are coming in, just put them to work. Business people are just saying, get them work permits and put them to work. They want to work. So that is a solution to some of the. And then the other end is legal immigration when it comes to more skilled jobs like tech and so forth.
Yeah.
That was incredibly decreased. And so there has to be reskilling and there has to be legal immigration for skilled workers in things like tech. That has to come back.
So what are clients telling you at this point? Are we likely to see a big slowdown as far as spends are concerned, investments, expansion plans, given the fact that you now start to see a softness coming in as far as consumer spending is concerned? How are companies reacting to this?
So, Shereen, I will tell you, so in the U.S. in particular, I think, 2 or 3 months ago, I think people felt that, the Fed was doing a good job, that eventually they'll get to stabilizing and then cutting rates. And so people thought, okay, we might have a slowdown. It'll be a couple quarters, and then we will move on. Now there's more of a negativeness going on. There's more of a feeling of this is going to take a little longer. There's really a negative around most of calendar year 24. So I think really people want to see, companies want to see some real confidence in rates going down. And so far,
it doesn't look like we're going to see rates going down anytime soon. The hope is that we won't see another rate hike.
Right. But even if there are no more rate hikes for a couple of quarters, and I think the central banks, and this is true almost globally, not just in the U.S., give a sense that rates will start coming down, even in the third quarter of 24 or something further out there, I think that'll start giving some confidence in terms of what's going to happen. Because right now, without the confidence that rates are stabilizing and or going down, people are very hesitant to really do much in terms of transactions and things like that. So I think there has to be that confidence built in for the economy to really start taking off.
We've gotten used to dealing with different kinds of risks, and especially through the course of the pandemic, whether it's rates or inflation and geopolitics, which really is emerging as perhaps the big risk. I mean, that's what Jamie Dimon said when he spoke to me a couple of weeks ago here in India. How are you reading that, and how are CEOs now starting to factor that into plans? It's no longer just China or Russia, Ukraine. You now have the Middle East to factor in.
That's a good question, and it is now we always talk about what are the top 3 things CEOs are worried about. Geopolitics now is at the top of the list, and I think people are looking at their supply chains. They're looking at who they're dealing with. The whole friend-shoring concept is out there, and they want to make sure that wherever they're investing, that they're going to be able to have a government that's friendly with their home government. And I think that's important. And that's something that, the West right now, Europe, the U.S. is pretty aligned. Certain countries in the Middle East are aligned. I think India is aligned. And then I think others are not in that fold. So it's a worry. What's going on in terms of Israel and Palestine is just really incredibly sad. Incredibly sad in terms of what's happened. This is something that, is not good for anyone.
No, and unexpected.
Totally unexpected. And it's something that, no one wants to take sides on things, but when one side does something unexpected and that horrible, it's hard not to take sides.